Hi guys, Alec back again, and I wanted to go through an interesting profit and loss statement here. Many of you business owners shy away from really understanding your P&L, but hopefully this review will shed some light into interesting things that you should be aware of as a general manager or owner when it comes to your accounting. You don't need to know accounting in order to understand some of the basic numbers that are coming on here. Your bookkeeper or your accountant will take care of the numbers, but it's your responsibility as an owner or general manager to understand what you're looking at. So I have a little bit of an extreme one here, but hopefully you'll get the understanding. I've named the company Flounder Engineering Company because it is floundering. And that is not the real name of the company, by the way, in case you were wondering. But what is interesting is that they have 13 streams of income, and I've renamed all the streams. I've changed some of the numbers to protect the identity of the company. But anyway, we have 13 streams of income, but look at the cost of goods sold. The direct costs are almost nothing. We've got $5 million in sales. We only got $133,000 in cost of goods sold. Maybe that would be the case if this was a software company. Maybe, but we don't have a software company. We have a company that's doing engineering work. A lot of it is not in the office. It's on customer sites. So there's a lot more cost of goods sold here than shown. You may be wondering, well, what's the difference? It's just a cost. Well, the reason to understand your cost of goods sold, and I've covered this in some of my previous videos, is that you can't calculate your break even. You can't calculate it if you don't have an accurate cost of goods sold. And the other thing is, it makes it awfully difficult to understand what your bottom line pricing should be when you're bidding a job. If you don't have this set up properly, you're just running blind. And a lot of times with these kind of companies, they'll add in all their material and then they'll double the price and then they'll say, okay, that's the labor and that's my cost. No, that's not how you do it, because you may not be capturing all of the required overhead that you currently have in your business. So that's why it's important to have a proper structure on your chart of accounts. And an accounting professional may not be able to help you because they have an accountant, they have a CPA. Do you think this is set up right? Absolutely not. Does the CPA really care? No, not really. Why? Because a cost is a cost, right? Cost is a cost for the CPA, who has to maintain accountability to the IRS and to the state that they're working in. However, being accountable to the IRS and the state does not help the business owner. So that's why it's important to understand what your direct costs are and what your indirect costs are. What's the cost of what you're doing out in the field, the cost of producing your services or goods, and what's the cost of your office? So again, the best way to understand that is if you have a cost that you have to incur to produce a good or a service, that's a direct cost. Anything to keep the office open, for instance, an administrative staff or a salesperson, or paying the utility bills or paying the phone bill, property taxes, those are all overhead items. You're going to pay them regardless of whether you have $1 in sales or not. So that's an easy way to describe the difference between the two. But it's important to have your chart of accounts in your accounting system set up properly. This is absolutely a mess. It's not set up properly. So why am I showing you this? Because this company is doing $5 million a year in sales. But wait till you see what their profit is. Okay, let's look at all that. So all the other costs are lumped into overhead. So here's all the other costs. I'm not going to go through all these in detail because a lot of them are actually, there's a lot of opportunity here to reduce and modify and improve. But let's look at the last line. So we've got all of our costs here, and look at this here, total expense. $5.65 million. What was the sales? Total income? $5,018,000. So we're pumping $5,018, and our costs are $5,652,000. So that means we've got almost a $750,000 a year loss. Now, there just happened to be a loan forgiveness here from the PPP, but guess what? That's a one-time event. Not going to happen again, most likely. Government's not going to hand out cash. So, we have a company that lost almost $750,000 after we throw the PPP in. Okay, but they're still in a loss position. They lost $41,000. They pumped in $5 million worth of sales, and they lost money. It's unfortunate. But why does that happen? The reason that happens is because ownership is not doing their job. They don't know what they're doing from a cost structure standpoint. They're allowing things to happen that should not be happening. Should never be in that kind of position, especially if you have an engineering company. Engineering companies, if you look at the average across the entire United States, they average about 9.5% in net operating income. They don't lose money. 9.5% is the average plus that these engineering companies are making. And so this company has problems. And as it stands, if this kind of stuff continues, as you can imagine, you can't keep going negative. If you looked at their balance sheet, they actually have no money in the bank. They have no money in the bank. And they have a loan, an operating loan, somewhere around $400,000 that they've dipped into, and they're still losing money. So the point of all this is this particular company will not do better with a cash injection. This company needs to manage what they're doing, and they are not being managed well. So there's a perfect example of a floundering flounder company that you don't want to be into, and you don't want to become this. So now, let's go back to the first page. See all these income streams? Your accounting system needs to tell you what is your profitability, at least from a job costing standpoint. So, in other words, each one of these income streams should be paying a portion of the overhead, and at the end of the day, all the overhead is paid from these 13 income streams in a proportional manner. It's probably the easiest way to handle this. And then you can figure out whether or not you're actually profitable in any of these income streams. So I've just explained to you how to do it. Your QuickBooks probably won't give you a direct answer. They're going to give you an answer based on direct cost, job costing, but you still have to factor in the overhead percentage, which isn't difficult to do, but it most likely won't be able to do that. There'll have to be some outside work to be done in order to get that accomplished. If you need help in getting something like that set up, I can help you do that. So that's all I wanted to say today. If you have any questions, post them down below, and I will get back to you. If you need to get in touch with me, the contact information is down in the description of this video. And thank you for watching. And don't forget, if you like this video, give it a thumbs up. And don't forget to share, subscribe, and ring the bell so you get the very next videos in a timely manner. Till next time, keep raising your profit.